Still plenty of people joining, so thank you for everyone who's online. Got a record, or almost a record number again today. Over 700 people registered for today's webinar, which is fantastic. So thank you for joining us. Thanks for your support, and we will kick off very shortly. Okay, let's get started. So thanks again, everyone, for joining us today. We've got a fantastic webinar and guest joining us as we discuss how to use company financials to spot signs of business failure. Before we get started, as always, for today's webinar, if you do have any questions, please feel free to use the Q&A box within the GoToWebinar control panel. We will have hopefully some time at the end, just depending on how long the webinar goes for. And as always, if the questions require a little bit more in-depth response, we'll get back to you either via email or a phone call. So please don't feel that we've deliberately missed you. We will be recording today's presentation, and we'll be sending out a copy of that recording as well as the slides that you'll see as well. So thanks again for coming on board. Looking forward to getting into this. A little bit about CreditorWatch. Australia's leading and most innovative commercial credit reporting bureau with over 50,000 customers. A huge product suite that we have now, ranging from the core product around credit reports, credit scores, monitoring and alerts. Data Logic allows you to analyze your age trial balance as a whole and identify slow paying customers, either those that are paying you slowly and the market faster, or vice versa, those who are starting to slow their payments to other suppliers, which is something that is certainly happening quite a bit at the moment. Directed due diligence looks at the individuals behind a company. Apply Easy is our online credit application, and importantly has electronic signature or digital signature capabilities, which is certainly a benefit in today's current environment where we want to limit touch points and contact points with other people. And then PPSR Logic is our all things PPSR related solution. Financial risk assessments we'll be discussing today, and the final one there, Portfolio Health Check, provides a comprehensive review of your database. That can be debtors, suppliers, partners, anything. It's a great way to get a better understanding of where you stand and what your customer base typically looks like from a credit risk perspective. Very important as we come out of this lockdown hibernation stage and start to trade again. All of these have links in them, so when you do get the slides, feel free to jump through to the link, or you can jump online and access more information about all of those products and features. So today we're lucky enough to have Shivantha join us as our guest speaker. He is the founder and CEO at CreditSource. He will go into a little bit more detail about that, but he's led credit risk function for multinationals and some of the biggest companies, financial institutions in Australia. He comes with a huge amount of experience in the industry and in credit risk and financial risk analysis. And as you can see there, he can really provide some fantastic insights into how we should be assessing credit risk, particularly today looking at utilizing financials, whether that is financials that we're able to access from the ASX, if they're a public company, from ASIC, if they are a reporting entity and have to load copies of their financials on an annual basis, or potentially you're able to get access to financials of your customers or suppliers direct from them. Shivantha has got a great presentation lined up for us. So Shivantha, thank you very much for joining us today.
Thanks, Patrick. I hope you can hear me.
Yes, can hear you loud and clear, and I will now pass over to you. So bear with me and you can kick off. Okay. Have you got access there? Excellent.
Hold on, I'm just checking. Yeah, absolutely.
The floor is yours. So thank you for joining us today. Feel free to expand on CreditSource. You certainly do a better job than I do. And yeah, let's jump into it.
So thank you, Patrick. And thank you, everybody, for joining us today. So when I meet somebody for the first time and the question comes up, so Shavanta, what do you do? I explain to them saying, look, I look at financials and I analyze financials. And the next usual question that comes up is, what could possibly be so interesting about financials that has made you look at them for 25 years? Well, many people think that financials are a set of documents which talks about some boring financial data of an organization. In reality, financials actually contain a lot of insightful information that you can use in order to look through and understand how a company is performing. Now, financials can be used to assess your customers or your suppliers. And as what you can see over here, it can be used to look through the outer appearances of an organization, through the skin and the flesh, to find out the bare bones the organization is made out of. And today, what I want to take you through is a few little tricks, tools, and methods that can be easily used by anybody to break down a set of financials and find out what exactly is going inside an organization. And in the process, we'll be using Virgin as an example to illustrate the findings. So if you look at the financials, there are a few different areas within it, but the most simple and perhaps the most basic two areas that you would find in the financials is the profit and loss statement and the balance sheet. Although these are simple areas, they by themselves provide sufficient information for us to figure out what's going on. Now, the profit and loss statement, or the P&L, as you know, essentially talks about the income a company generates and how it spends its money. If the company generates more income than the expenses, we would say that the company is making a profit. And if the reverse is true, the company is making a loss. Now, the balance sheet is a snapshot in a point of time, usually at the financial year end. The balance sheet would show the assets and the liabilities of an organization. Now, essentially, what that means, it shows what a company owns and what it owes to others. Now, financials can be a bit of a complicated area, and it's good to have a bit of a disciplined methodology when you try to analyze it. Now, today I would look at financials using 4 angles, which is revenue, profitability, solvency, and liquidity. So let's take one at a time and try and understand this a bit more. Now, revenue is an important item for us to understand the size of an organization. Revenue by itself provides the information on how big or small a company is. But when you look a bit more closer into the revenue and break it down a bit more, it provides some other information which is quite useful. So the other two areas that I would like to look at in terms of revenue is how the company has been tracking in terms of the trend. How well has the company performed over the years in terms of generating revenue? And the next area is to, in fact, go in and see where the revenue is coming from. What are the revenue sources? What products and what markets provide the company that we are analyzing with the revenue. So let's take an example here and try and understand this a bit more. So supposing a company came and said, look, I want 100,000 credit limit to buy goods. And if I have access to their financials, I look at it and I say, the most current revenue the company has generated is $10 million, as you can see in this graph over here. So that would tell me the company is making $10 million a year, and I would say 100,000 credit limit is probably reasonable, and I'll be happy to grant it. Now, supposing the same company comes and say, look, I make only 200,000 revenue a year, well, I'll be less reluctant to grant 100,000 credit limit because that will be a bit over the top given the size. So this explains that looking at the size of the company is important for us to determine what type of a credit limit that we have to provide to a customer, for instance. Now, if I have access to more than just the current year's revenue, if I have access to the previous year's revenue as well, and if I look at it, and I see that in 2018, the company made $20 million and it was down to $10 million in 2019, well, I might be a little bit less excited about giving that 100,000 credit limit because as you can see, the revenue has almost halved. If I have access to one more year, and if I see that this is the trend of the revenue, then I'll probably not even consider giving the credit limit that I was happy to give in the first place, because I can see the revenue is trending in a quite a negative manner, and soon this company might find itself not existing at all. So this shows the importance of not looking at just the revenue in isolation, but the revenue trend. We can also look at where the revenue is coming from. So I've taken another example to illustrate this a bit better. Supposing company A is in the business of manufacturing refrigerators. So as you can see over here in this little pie chart or the donut chart, the 50% of the revenue comes from the sale of domestic refrigerators, 30% comes from selling refrigerators to hotels, and 20% comes from selling refrigerators to truck fit outs. Now, knowing what we know about COVID today and how the hotel sector has been affected by it, we'll be a bit concerned over here because 30% of the revenue of this company comes from the hotels. So this company is expected to have a dip in their revenue. Now let's look at another scenario. Let's look at company B. Now this is far worse than company A because in this example, 60% of the revenue of company B comes from the hotel sector. Now, if we are to make a choice in dealing with company A or company B, we might decide that it's better for us to deal with company A because they're a little bit less riskier. So this is the importance of trying to figure out where the revenue comes from. Again, if you look at the financials, in most instances, you would find out the financials describe where the revenue is coming from for the organization. So we're going to now look at how Virgin fared in terms of the revenue. So as you can see, if you look at the 2019 number, you would see that Virgin's made a pretty good revenue. They've ticked over $5.8 billion. That's an impressive number. And if you look at the trend, you will also see that Virgin has been trending in the right direction, making more and more revenue every year. So from a revenue perspective, up until that point, we could say they have done reasonably well. If you look at the revenue sources, you can see that they are extremely dependent on one area to generate all of their revenue. Now, given Virgin is a passenger airline, that's not abnormal, and that's just a fact of life. However, there is a risk when a company is exposed heavily to one particular area to generate all of their revenue, and when that area is affected, it can have dire consequences. Now, that's about revenue. So on an overall basis, we could, however, say that Virgin has done reasonably well in terms of the revenue. Now, the next dimension that we want to look at to analyze financials is profitability. Profitability simply is, income minus expenses for a company is what you have at the end as a profit. It's important for a company to consistently make profits because if you spend more than what you earn, soon such a company would not be able to pay for their supplies or not pay their employees or not pay the bank. So it's important that a company continues to make profits as they tag along. Now, the profits a company makes depends on the cost structure of that company. So it's important to understand the various cost elements of a company that you want to analyze. So if you look at a profit and loss statement of an organization, there'll be a number of cost elements that you can see in there. Now, what we want to do today is to put all of these costs into three main buckets. The first one is prime cost. Now, prime cost is the highest cost that a company would incur and the most important cost for that matter. If it's a manufacturing organization, we could say that the prime cost would be the raw material cost. If you're running a call center, you would say the prime cost would probably be the staff cost. Now, for airlines such as Virgin, the prime cost would be your fuel charges, the airport charges, or the staff expenses. It's quite important for companies to have a very tight control over your prime cost because they are the main cost drivers for you. Accordingly, any slight variations in the prime cost means that you are making substantially more money or substantially less money. Companies also have a number of expenses. Now, the expenses could be advertising expenses, sales commissions, could be rent, etc. While expenses are unavoidable, one must have a look to see whether a company's expenses are in line with what they do and the scale of this company. Supposing the expenses are a bit too exuberant, then it will eat into the profitability of the business and a company can end up not making profits. Now, in the financial statements, you can see that the finance cost is shown separately. It's another expense item, but it's a significant expense item. Now, finance expense is incurred, as you know, when you borrow funds or loans from a bank. Now, the more you borrow, the more that needs to be paid in terms of interest. Again, we need to see when we analyze the financials that the interest payments a company makes is in proportion to what the company's operations are. If the interest amounts keeps on increasing, then the company may soon find itself in an unprofitable situation. So what are the tools we can use to see how profitable a company is, or how well a company is performing in terms of profitability? The first thing that we can look at is the gross profit. Now, the gross profit is essentially revenue minus the prime cost, the most important cost. Now, it's important to make a reasonably high gross profit because that's what a company is left with to pay for all the other expenses. If a company doesn't make a sufficient gross profit, well, at the end, the money left won't be enough to pay for the other expenses. The second thing that we want to look at is the gross profit ratio. Now, why is a ratio important? Comparing dollar figures between years is sometimes not useful. It doesn't provide the right insights. However, using a ratio provides a better insight as to how a company is performing year on year. Shortly, I'll take you through an example to explain this a bit better. The other area that we would like to look at from a profitability perspective is EBIT, or earnings before interest and tax. So why is this important? EBIT essentially talks about how much earnings a company is left with before interest and tax is paid. In other words, how much money is left to pay interest and tax. If the EBIT is less than the interest and tax amount, we can say that this company would struggle to pay the interest and the tax component. Now, again, both are important. Many organizations needs bank loans and bank facilities to operate on a day-to-day basis and to fuel growth. Essentially, if it is not able to pay the interest component, the bank might turn around and say, look, we don't want to lend to you anymore, please return our money. And if they continue not to pay the interest, the bank may even foreclose on the company and put it into administration. Tax is the same. The ATO expects all companies to pay the tax at the end of the year. And if a company is unable to pay the tax, the ATO would look at that favorably and they might place the company in administration. So it's quite important that all companies have the capability and makes enough money to pay interest and tax. And that's what's shown through EBIT. Finally, net profit. Now the net profit shows that after deducting all the cost, how much money is left for the organization. That's what you carry home. So let's see how Virgin fared in terms of profitability. So to your left, you can see that it's a profit and loss statement, or rather an extract of the profit and loss statement of Virgin. Now let's see how Virgin has performed in terms of the first ratio we talked about, which is the gross profit. Now, as you can see here, in 2019, Virgin made a gross profit of nearly $2.2 billion. And if you look at it, year on year, they have been trending pretty well. So it looks that they've done all right over here. Now, we talked about using a ratio to make more insightful findings when we compare a financial indicator on a year-on-year basis. So let's look at how Virgin has fared in terms of the gross profit ratio. If you can see that, you will see that the gross profit ratio has actually fluctuated from year to year. And in fact, it has reduced from 2018 to 2019. Now, one may say, looking at the gross profit ratio over there, the reduction from 2018 to 2019 is only about 1.5%, a small amount. But put it into perspective, had Virgin achieved the same level of gross profit ratio, or if the gross profit ratio in 2019 was the same as 2018, they would have made $90 million more as gross profit in 2019. So as you can see, even a slight fluctuation of the gross profit ratio can have some dire consequences. Let's look at what EBIT is. Now, we talked previously that a company should earn enough money to pay the interest and tax. But as you can see here, the EBIT is negative, which means theoretically, Virgin didn't have a single dollar that was available to pay the interest and tax. So from an EBIT perspective, Virgin has not done that well, and it's a concerning situation. If you look at the net profit, you can see that year on year, for the last 3 years, Virgin has been losing money. And cumulatively for the last 3 years, they have made losses of more than $1 billion. So all in all, using these few tools, we can say from a profitability perspective, Virgin has fared very poorly. Now, the next area that we want to look at is the area of solvency. Now, solvency essentially talks about maybe the best way to talk about solvency is actually to look at the opposite of solvency, which is insolvency. Now, we say a company is insolvent if the assets the company has is not sufficient to pay all the liabilities or dues. So solvency and solvency ratios talks about a company's ability to keep on paying its debts and obligations and to operate into the future. Now, solvency is quite an important area for any organization. So we'll be using 5 different angles today to look at how solvent a company is. Now, the first thing to look at is the net worth of an organization. The net worth is all the assets, take away all the liabilities. That's the net worth of an organization. Another way to look at this is if a company was to cease operating today, and if it was to sell all the assets and settle all the liabilities, how much money is left? Well, that's what the net worth is. Now, a lot of organizations carry what's called intangible assets in their asset portfolio. Now, intangible assets can be things like goodwill. In the case of Virgin had nearly 600 million in terms of goodwill in its asset base. Now, in a situation where there is some distress, the intangible assets are not as valuable as what it might appear. So therefore, a conservative way of looking at solvency is to look at tangible net worth. Tangible net worth is looking at the tangible assets and taking away the liabilities from it. Another way to look at solvency is through gearing, or which is also called as debt to equity ratio. Essentially, what gearing and debt to equity ratio show is how much of borrowed money is in a company compared to how much of owner's own money is in it. Now, as a company borrows more and more money, the debt to equity ratio or gearing ratio keeps going up. Higher the debt to equity ratio or higher the gearing ratio, more risky such an organization becomes because it's got more and more borrowings in its balance sheet. The final indicator that we can use in order to understand the solvency of an organization, it's what's called interest cover. Now, interest cover is essentially, we talked about EBIT before, that is earnings before interest and tax. So interest cover is calculated by dividing EBIT from the overall interest expense the organization has. It is expressed in terms of number of times. So as an example, if the EBIT of the organization was $10 and if the interest payment was $2, we say the interest cover is 5 times. So let's again dive into Virgin and see how well Virgin fared in terms of solvency. So to your left-hand side, you can see an extract of Virgin's balance sheet. And if you move to the right-hand side, we can see the net worth and how it has tracked over a period of 3 years. Now, unfortunately, you can see there that net worth of Virgin has continuously deteriorated. And the main reason for that is if you look at, again, go back to the left-hand side where the extract of the balance sheet is. If you look at over here, the Virgin continuously made losses, which means their retained earnings deteriorated over a period of time. And as a result, you can see that the net worth has kept on coming down. Now, we said perhaps a more conservative way of looking at it is to look at the tangible net worth. So let's look at what the tangible net worth is. That looks, far more scarier than the net worth position, because as you can see, from having a tangible net worth of close to $1 billion in 2017, Virgin has been able to lose almost all of that. And in 2019, the tangible net worth was a mere $38 million. Now, if you look at the debt to equity ratio, you can see that in the first graph over there, you can see that year on year, the debt to equity ratio has jumped up. Now, this is not a good sign. Why the debt to equity ratio has gone up is despite the equity coming down, Virgin had to borrow more and more money to keep the business running. So as a result, the debt to equity ratio has continuously gone up. Now, if you look at the interest cover, well, there is no interest cover because as we previously discussed, the EBIT or the money available to pay the interest has always been negative for Virgin. And we can say that Virgin has not been able to have a reasonably good interest cover over the last 3 years. So looking at it from a solvency perspective and using these little tools that we talked about, we can conclude that Virgin had some serious solvency issues. Now, the fourth and the last area that we want to look at is liquidity. So what is liquidity? Liquidity essentially talks about how well a company can pay its most current obligations. After all, a lot of the obligations that a company has are current. You got to pay your creditors, you got to pay your short-term bank loans or settle your overdrafts in the short term. So liquidity talks about the liquid assets a company has that can be used effectively in order to pay the day-to-day debts. A company might be quite asset rich. They might have a lot of buildings, a lot of lands, a lot of vehicles, but these assets cannot be quickly turned into liquid assets. Along with having other assets, it's quite important for a company to have liquid assets such as cash or cash deposits in banks. So let's look at what methods we can use in order to figure out the liquidity position of a company. So there are many ratios and many tools. I'll talk about 3 of them today. So the first one is the working capital. Working capital is a simple calculation. You take the current assets minus the current liabilities, you get what's called the working capital of an organization. If current assets are more than the current liabilities, we say such an organization has a positive working capital. But if the reverse is true, we say that working capital position is negative. It's quite important for an organization to have a positive working capital position. The second ratio that we want to look at is the current ratio. This is simply calculated by dividing current assets by current liabilities. As a rule of thumb, a good current ratio is considered to be 2 or above. That means if the current assets are twice as high as current liabilities or more than that, it's considered good. If the current ratio keeps on dropping from this point, we say that the company could have liquidity issues. A more conservative way of looking at liquidity is the cash ratio. Now, the cash ratio uses not all the current assets, but only cash and near cash assets, such as short-term bank deposits, and see how much of these cash and near cash assets covers the current liabilities. Now, as a rule of thumb, again, a cash ratio of 0.6 to 1 is considered good. In other words, if the cash and the near cash assets are sufficient to cover approximately 60% of the current liabilities, we say that's a good position. If the cash ratio was to drop below this point, we say that the company could have some liquidity issues. Now let's again dive back to Virgin to figure out how they fared in terms of liquidity. So as you can see over here, on the left-hand side, again, is an extract of the Virgin's balance sheet, but we're showing only the current assets and the current liabilities over here. Now, if you move into the right-hand side and have a look at the graph over there, which illustrates the working capital situation, you can see that it's been continuously negative. Now, that's because the current liabilities over here has grown much faster than how the current assets have grown. As a result, Virgin continuously had a negative cash flow situation or a negative working capital situation, which has substantially deteriorated from 2018 to 2019. If you look at the current ratio, again, because the current assets are far less than the current liabilities, we can see that the current ratio has been less than 1 and in fact has deteriorated further from 2018 to 2019. Finally, if you look at the cash ratio, you will see that the cash ratio has continuously dropped and it's at 0.54 times or 0.54 times in 2019. So it's interesting to look at the cash ratio over here and then compare that to the cash position right at the top. Now, if you look at the 2019 cash position, you would see that it's quite high. It's $1.7 billion that Virgin had. But the cash ratio shows us that when you put it into perspective with the current liabilities or the liabilities that needs to be paid in the short term, that $1.7 billion is not actually a lot of money. So on an overall basis, from a liquidity perspective, we can say that Virgin had some serious issues over here. So let's look at using these few areas that we talked about, how Virgin performed on an overall basis. From a revenue perspective, we can say that they've done all right. I mean, revenue's grown, it's reasonably high. We know that it's not very diversified, but on overall basis, we can say that it has been satisfactory. Unfortunately, this is where the good story ends for Virgin, because all other indicators was not satisfactory for Virgin. If you look at from a profitability perspective, we saw that their cost base has been continuously increasing and has been much higher than what they earn. As a result, Virgin continuously made negative profits or losses. From a solvency perspective, we saw that the equity position has kept on deteriorating, and the tangible net worth we saw as is almost zero. And we also saw that the leverage or the debt to equity ratio has continuously crept up, and we also saw that Virgin was not able to service its interest effectively. From a liquidity perspective, we saw that due to increase in borrowings, the current liabilities kept increasing compared to current assets, and Virgin just didn't have a sufficient level of liquidity in order to service its day-to-day debts. So on an overall basis, it shows the problems Virgin had. Now it's important to note over here, the financials that we used in this analysis is not the current ones. These are financials that was available way back in 2019, long before COVID-19 and long before Virgin went into administration. So as you can see, by looking at the financials at that time, it clearly indicated the problems Virgin was going to have. So perhaps what we can say at the end is, by looking at the financials, not only can it help you look through and see what the bones are made out of, and using the little analytical tools that we talked about, perhaps you can stitch a nice little story here as well and figure out the man is actually running because maybe something a bit scary is chasing it. Let me now pass it on to you, Patrick.
Thank you, Shivanta. That was great. And I think one thing I will talk about here is Virgin's obviously a big example to use, one that everyone is familiar with. However, these types of businesses I would describe almost as zombie businesses, and it's a term is being used in the press, and I've used it in interviews with journalists of late, and that is companies that went into this corona period who were probably on the brink of administration or being wound up either voluntarily or by creditors. And ultimately what has happened is we've seen insolvency law changes introduced by the government, giving directors the ability to essentially trade insolvent, or protection from trading insolvent for 6 months through to around the end of September. Stat demands not having to be answered for 6 months, and bankruptcy in a similar sort of situation as well. So essentially, I think what we'll see is lots of these companies who, to be honest, should have gone out of business, around that corona outbreak period, around the time that the changes were made from an insolvency point of view, have taken, not advantage, but they've seen that these changes have come in, and it's given them the ability to take stock and go, okay, well, hold on, let's hibernate for 6 months. Hopefully something changes and our business can bounce back, and something needs to be fairly magical, I would imagine, because the economy is certainly not going to, improve from where they left off, and unless they can pivot their business significantly to sort of take advantage of current market conditions, we will see that a lot of these zombie businesses will end up in administration, and we're certainly expecting to see a large increase, a big wave of insolvencies, administrations around that, leading up to September and just after September, as these companies realize and the directors realize, okay, well, there's no way we can bounce back from this. There's no way we can continue to trade. And that's on top of all the other businesses that have been affected by Corona directly and were potentially trading well pre-Corona. So where this financial risk assessment provides a fantastic bit of insight is the ability to really dig deep and see and identify those businesses, those companies that were struggling pre-Corona. Okay, and it's not Corona that is going to tip them over. They were actually on the verge of falling over in the first place. So I think Virgin's a fantastic example to use. Obviously, it is a large one, and there's extenuating circumstances around the fact that they're very exposed to, or completely exposed to to travel. There's plenty of people that I've spoken to out there saying that even if Corona didn't come along, an administration or a serious restructure of Virgin was most likely going to happen anyway. So Shivanta's obviously taken us through how to perform a financial risk assessment. Of course, most of you, hopefully all of you, know that CreditorWatch does provide financial risk assessments themselves. So if you have the ability to read access financials and read them yourself, fantastic. It's a great skill to have, to be able to take advantage of the information that is out there, regardless of whether you're getting that from the ASX, from ASIC, or direct from the company you want to run the assessment on. However, of course, CreditorWatch also does provide these financial risk assessments. They're a transactional product that you order from within your CreditorWatch account, and I will jump in and show you that now. So I'm, of course, obviously using Virgin Airlines as the example. So run the report. In the report itself, you will be able to see on the right-hand side, financial risk assessment. By clicking on that, you have a pop-up that comes through and it gives you the ability to select a few things. So we've got two types of reports that we provide. There's the financial risk assessment report and then one with an analysis included. Now, the financial risk assessment report essentially is going to look at all of the financials themselves, as Shivanta has just displayed. It's typically provided either by an accountant or uploaded to ASIC or ASX. It's going to give you, flag any sort of concerns from a numbers perspective, showing you profit, loss, balance sheet, exposure, that sort of thing. The analysis report, however, that second one there, will actually have more of an in-depth commentary from a CA, CPA equivalent individual who will assess the whole report itself and then provide their own sort of findings and opinions as a result of that data that they're seeing in the financials. So obviously you're getting that. It's almost like having a CFO or a financial analyst within your business being able to provide that. Essentially, you get an outsourced version of that in the report itself. Financial data source, ASIC or ASX. So if you know it's available with ASIC, ASX, you can select that. If you're providing it yourself, or we're going to have to go out and access that direct from the company, CreditorWatch has a facility or has a resource to assist with that. So if they're not a reporting entity, select that self-provided financial, and we will assist in collecting those financials. Of course, the company has to consent to that. If they don't want to consent, well, then obviously that's a bit of a red flag for you to consider whether you want to, offer a credit limit or take them on as a supplier potentially if it's a tender. Ultimately, it's up to you to say to them, hey, you need to provide these financials so we can perform a financial risk assessment. If we can't get access to that, well, then potentially we can't do business together. But again, CreditorWatch will assist with that. And then the last one there is the number of years worth of financials. You saw there the importance of a trend. 2 years is great, but having that 3-year trend is a much more powerful tool. So that's how you order that from within the credit report. Of course, CreditorWatch can help you with that, your account manager, live chat, for example. And For more information, there is a link here on our website, Financial Risk Assessment. So a bit of general information, what's included in the reports, etc., and some frequently asked questions. And then one final thing I will add in there, I haven't got a line item in there, but we can do what I would call customized financial risk assessments. So there are from time to time the need for more in-depth financial analysis that requires, you know, a few more hours put in by our analysts. You may want to assess a group of companies, for example, parent companies and the sibling companies. We're always open to discussing that further. So if you find that financial risk assessment with analysis isn't enough and you've got something else in mind, then just talk to us and we can obviously assist in getting you exactly what type of report you require. So one last thing before we wrap up or have a look at the questions. We've obviously been going for quite a while, so we'll have I know Shivant is having a quick look at the questions now. If there's anything that we can answer quickly, great. If not, we will get back to you if you have asked a question. So just a quick poll that I will run here. Would you like to be contacted regarding financial risk assessments? Just bear with me, it is trying to load. There we go. This just allows us to get in touch with people a little bit quicker rather than those people who do want to be contacted about it having to get in contact with us. So don't be afraid to say no. Hopefully you've got something out of the webinar itself in terms of you know, the content today. If you don't want to be contacted, that is of course fine. But for those who do want to be contacted, please let us know and we can get in touch in a fairly quick manner for you. I'll give that another 5 to 10 seconds and then I will close that down and we will have a quick look to see if there's any questions that we want to answer. Get your votes in. I'm going to shut this down. Okay. Now bear with us, jump in. Plenty of questions have come through, so give me a second just to have a look at them. One here, is it fair to say that the first step is to understand the business model for the financial statement to make sense? So Shavantha, I will call on your expertise here.
Yeah, sure. Really good question. And it's absolutely important to understand the business model before you dive into any other ratios and talks about looking at it. However, what I should mention is that the ratios that we use today is more generic. They can be used across industries, across organizations to get a good sense of what's going on. But it's absolutely important that before you start interpreting information to understand what industry a company has been operating in.
Excellent, thank you. Another one here, do we need to consider sector-specific ratios for comparison purposes?
That's a very good question as well, and it sort of aligns with the previous question that we talked about. Certain sectors would have certain ratios that are a bit more relevant for them. So yes, it's beyond today's, beyond the scope of today's webinar to talk about some such minute but very relevant sort of analysis. But what is required is that when you do analysis and look at ratios, it's quite important to have a look at where exactly the company that you're analyzing is performing in and try and have a good understanding of what that industry is. So the answer is yes, it's absolutely relevant.
Yep, great. Just a couple of sort of questions regarding the session today. Obviously, yes, we will be providing the recording and the slides. We do have example reports that we can provide, and what we might do is include an example report in the follow-up email so you can have a look at what that looks like. I understand that the poll page wasn't responding for everyone. So if you were interested in being contacted but you didn't get a chance to respond, please reach out to us or just put a message in the Q&A section now. I will leave it open for a little bit once we do finish up so that you can let us know that you wanted to be contacted. There's a question here around, I believe, is there a reason why Virgin only just went into administration now despite making a loss for the last 3 years? So as I understand it, they've made a loss 9 out of the last 10 financial years. Ultimately, and Shivanta, you could correct me here, but they've always had access to capital. They've done raisings over the years and had access to plenty of debt. So they certainly weren't out of money. But I think the writing was on the wall with COVID that they certainly were going to run out of money. And the latest is that I read in the paper was that cash is going to run out in June unless they get some sort of lifeline or a deal is done with a new owner. So I think that is that's hopefully answering your question there. I know that there's a few others in here. There's probably a need to get back to you direct. Some of them are quite specific. Here we go. Is CreditorWatch able to provide this report easily for non-listed companies? Yes. So for companies that don't provide their financials to ASIC, or they're not a public company and therefore not lodging their financials with the ASX, we're able to provide this report based on financials submitted by that company. Now, there's a couple of ways to do that. One, you could ask that company for their financials in order to make a risk assessment. Or a CreditorWatch a resource. If you do order that report, we'll contact the company on your behalf, and we do that with a template, and hopefully off the back of an email from you or a call from you to that company saying CreditorWatch will be in contact in order to access financials to make that risk assessment. That's probably taking us right to the limit of our time. I know that a few people are starting to drop off now, and I'd like to leave on a high. We will get back to these questions in the next day or so. So I apologize if we didn't get to it today, but we certainly will get back to you. So thank you to everyone who joined us today, asked questions, got involved. I appreciate you taking the time. I'm sure most of you are still working from home like I am. One day I will run one of these again from the office. However, until then, I wish you all a safe and healthy week, and all the best. Hope to see you again soon. Shivanta, thank you very much as well for joining us. And I think based on these questions, there's certainly going to be a follow-up session to this in the coming months.
Thank you, Patrick. And thank you, everyone.
See you later, everyone. Have a great day.